I don't think that we're going to have a formal default. I also don't think that the US dollar will do poorly in relative terms, which is to say against other fiat currencies. But I think the US dollar will do poorly in absolute terms. In the decade of the 70s, when the US was paying off its internal and external debts around the war in Vietnam, which of course we lost, and the war on poverty, which we lost, the answer to maintaining the level of public expenditure and political expedience was to devalue the US dollar, to reduce the purchasing power of the US dollar. According to David Stockman, the Office of Management Budget, the US dollar lost 75% of its purchasing power over 10 years, which meant that while the nominal level of our obligations remained the same, the net present value, the real value of our obligations, declined by 3/4.
Cool.
I believe, past this prologue, I believe over the next 10 years that the purchasing power of the US dollar, in US dollar terms, will decline by 75%.
Okay.
It's worthy to note that during that same decade, the 1970s, the gold price ran 30-fold.
Sure.
I'm not suggesting that the gold price is going to run 30-fold, but I wouldn't be surprised at all if the price of gold in nominal terms didn't mirror the decline in purchasing power of the US dollar. Well, I think globally, but particularly in America, the perception of inflation has been governed by 4 decades from 1982 to 2022, when inflation was less of a problem. You said earlier in this interview that we sort of stumble through and we get along. And that lulls us, I think, into a sense of insecurity. In 1982, at the beginning of this magnificent, epoch, debt to GDP was at about 90%. Today, debt to GDP is at 120%. So it isn't just the aggregate number of the debt, but rather the amount of debt relative to the economy that has to service the debt. More troubling are the off-balance sheet liabilities, the net present value of entitlement promises. I guess the icon for that is me, an old guy, Medicare, Medicaid, Social Security. The net present value of unfunded entitlement obligations, according to the Congressional Budget Office, exceeds $100 trillion, or 3.5 times gross domestic product. The sum of the on-balance sheet deficit and the off-balance sheet deficit, according to the Congressional Budget Office, is between $4 and $4.5 trillion a year. That number is very interesting because gross federal income, all of the money the federal government collects before it spends a dime, is only $5 trillion. So now you begin to see the problem. $130 trillion in aggregate liabilities, a $5 trillion federal income, and a $4.5 trillion combined federal deficit. By the way, I'll give you one more scary number. The Internal Revenue Service believes that the aggregate net worth, private net worth of American citizens is $141 trillion. So if we're worth 141 and we owe at the federal level before state, local, private, and corporate debt 130, the net for reinvestment in living is $11 trillion. And the other two numbers grow by between 4 and 4.5 trillion a year. My belief is the only way out of that is a good, honest default, which won't happen, or a dishonest default by way of reducing the purchasing power and hence the true cost of servicing the obligations. When people talk about resets to sell newsletters, what they're talking about is the overnight bankruptcy of the United States and all that. That's all horse pucky. I think what we're going to see is going to resemble very closely in that regard the decade of the 70s. An old codger like Rick Rule will continue to get his $4,000 a month or whatever they give me for Social Security. I don't know what it is. But 10 years from now, it'll buy $1,000 worth of goods and services. I watched that happen in the decade of the 70s. By the way, I mentioned earlier that Americans are conditioned to think of not to worry about inflation as a consequence of the last 40 years. It's worthy to note that most Americans conflate inflation with the consumer price index. The consumer price index is not a cost of living index. It's hedonistically adjusted, as an example, which means that the government tells you what the stuff that you buy is worth. Doesn't matter what you paid for it. It also doesn't include tax. If you can imagine a cost of living index that doesn't include tax, well, you live in some country that I don't live in. My suspicion is that the deterioration in the purchasing power of the US dollar is proceeding along at a 7.5% or 8% clip, rather than the 2.6% suggested by the CPI. The United States is still a place that's skilled labor short. There are jobs begging. In the little community that I live in northwestern Washington, there's such a labor shortage that people start bagging groceries at Safeway at $20 an hour. The minimum wage, which is $7.50, is irrelevant in this labor market.
Okay.
There is a young man who is able to do stuff for me that I'm no longer physically capable of doing. As an example, power washing my decks and stuff like that. This young man is 22 or 23 years of age. He has a pickup truck, he has a helper, and he has a water blaster.
Okay.
$160,000 a year. He owns a house and he just bought a second rental. People who don't have skills or who don't have moxie are in real trouble now. More and more people who used to trade sweat for a living and have no particular skill set, nor the drive to get ahead by purchasing a water blaster and a used pickup truck. People who are needed in Silicon Valley, that may change a bit with artificial intelligence.
Yeah.
Who have construction skills and are willing to employ those skills. This is still a skilled labor short economy. And it's an economy that is seeing very rapid wage inflation as a consequence of demand pull rather than cost push. But that does for people who don't have skills. The best source of American entrepreneurs have been immigrants, occasionally illegal immigrants. And there seems to be a protectionist bent in the United States, which suggests that if we don't take in highly motivated foreigners, there will be more jobs for lazy domestics. I have never seen an economy benefit from less competition. So you understand something about the way I feel around that. There is still, I think, an undercurrent in the United States of respect for work and success. And I think that cuts across races. I think it cuts across ages. I think that the people like Robert Reich and AOC and Governor Gruesome, I think those people are noisy. And I think that they tap into an underlying frustration among some Americans. But I mean, the election of Trump tells me that there is a very different counter theme at work in the United States, and in fact, globally, too. I know that through my work at Rural Investment Media, I come in contact with about 50 new people a day. And my message is decidedly libertarian. 92,000 people have asked me to communicate with them, the majority of them young, which tells me that there is an undercurrent of support for libertarian principles on a global basis that probably isn't reported very well by the mainstream press. I have a large holding in the Sprott Physical Gold Trust and Physical Silver Trust. Part of, as an old man, gold is heavy, and I don't like having to move it into a safe deposit box and then take it out and pay the sales commissions. So a substantial part of my gold holdings is surrogate gold, the Sprott product, where I can buy it with a click of a mouse and sell it with a click of a mouse, and they provide the storage and security. There will come a time, it happened for me in 2009, where there were other assets that were more attractive to me than the gold. And I sold some of my gold and used the money to purchase those other assets. And I suspect 10 years from now that gold will be in the same type of favor that it was in 1990 or in 2009 or 2010. And I believe, despite my advanced age, that I will switch out of some of my gold into some asset class that appeals, that appears more attractive to me at that point in time. I don't know what that'll be. I use 10 years because I sort of think in decade-long terms.
Okay.
It took the decade of the 70s to have the sort of reckoning that the United States needed. We needed to raise interest rates to the point where they were substantially greater than inflation to break inflation and break inflationary expectations. And we broke the price cycle. In the period 1979 to 1982, in the California market at least, residential real estate lost 50% of its price. Again, in 2008, 2009, 2010, many neighborhoods in the United States experienced 50% price declines in real estate and other assets. Very, very, very high quality common stocks sold off by 40%.
Yeah.
If you are psychologically unprepared for that and financially unprepared for that, you become a victim of that circumstance.
Yeah.
If you are prepared, you become a beneficiary of that circumstance. My best investment year in my entire career, bar none, by far, was 2009. I went into the 2008 collapse scared, cashed up, but I was prepared enough, having been an investor by then for almost 30 years, that when that liquidity-driven panic set in, I pushed the trigger and was able to buy stuff.
Right. Yeah.
And I suspect, I don't know, but I suspect that I will have the opportunity to do that again. And I hope, I hope that I have the clarity of mind to do it.